Hey everyone, and welcome back to the Gold Talk Show.
Great to be here.
Today we're doing a deep dive, really getting into what drives the price of gold.
Yeah, there's a lot going on there.
We've gathered some interesting data and reports to look at the forces shaping the market right now.
We'll be covering recent demand trends, gold's role for investors, central banks, the whole picture.
Exactly. The aim is to give you a really solid understanding of why gold behaves the way it does and, how its price is actually set.
Right. So where should we start? Maybe the latest demand numbers. Q1 2025.
Good idea. Let's jump in there. What did Q1 look like?
Well, overall gold demand was pretty strong, hit 12,206 tons.
Okay, how does that compare?
It's actually the highest Q1 level we've seen since 2016, up about 1% from last year.
So, steady increase. But I heard something about ETF inflows being a really big part of the story.
Oh, absolutely massive. ETF inflows were, they basically more than doubled the total investment demand.
Doubled. Wow.
Yeah, it was a 170% jump compared to the same time last year. That pushed investment demand up to 552 tons.
And that's a high number, right?
It's the highest since Q1 2022. Really suggests that, bigger players, maybe institutional investors, were moving seriously into gold funds.
Okay, so that's the paper gold, the ETFs.
Yeah.
What about physical stuff? Bars and coins? People still buying those?
Definitely. Demand there was so quite high, 325 tons.
And how does that stack up historically?
That's about 15% above the 5-year quarterly average. So yeah, still very strong demand for physical.
Any particular regions driving that?
China was a huge factor. It was actually their second highest quarter ever for retail investment in bars and coins.
Really? Second highest. That's significant. Shows a strong cultural pull towards physical gold there, doesn't it?
It certainly seems that way. A real contrast, big institutional money in ETFs, strong individual buying of physical, especially in China.
Okay, fascinating. What about gold used in technology, industrial demand?
That held pretty steady, around 80 tons, similar to last year.
Any trends within that?
We're seeing some growth in electronics demand, probably linked to AI adoption needing more advanced components.
Ah, the AI effect again.
Yeah, but there's a bit of a cloud on the horizon. Potential tariff uncertainty later in the year could challenge that sector.
Okay, so AI is a positive driver, but tariffs could be a negative one down the road.
Got it. Now, the price itself has been, pretty wild, record highs. How did that affect jewelry?
Yeah, the high prices definitely put a dent in jewelry demand. It fell quite sharply.
How sharply?
Lowest volume since the pandemic disruption back in 2020.
Okay, so people bought less jewelry because it was so expensive.
Exactly. But here's the twist. Even though the volume was down, the value spent on jewelry actually went up.
How much?
By 9% year on year to about US $35 billion.
Wow. So less bling, but much more expensive bling.
Precisely. Really highlights just how much that price per ounce has surged.
And speaking of that price surge, the LBMA benchmark price really took off in Q1. Absolutely. It set multiple new record highs. The average for the quarter was US $2,860 an ounce.
$2,860. That's a huge jump from last year.
Massive. It was up 38% year on year.
What were the main drivers pushing it that high? What lit the fire?
It was really a mix of things coming together, concerns about potential U.S. tariffs causing economic jitters.
Okay, uncertainty there.
Then you had ongoing geopolitical instability, tensions around the world.
Right, the usual suspects.
Plus, stock market volatility made gold look like a safer bet, and a weaker U.S. dollar also helped.
Weaker dollar makes gold cheaper for buyers using other currencies, right?
Exactly. So you had this kind of perfect storm of economic worries, global tensions, and currency moves, all pushing gold higher.
And when you add up all that demand, ETFs, bars, coins, jewelry value, tech what did the total look like in dollar terms?
In value terms, total demand was huge. Almost matched the record from Q4, hitting US $111 billion.
$111 billion.
Yep. That small 1% volume increase, combined with that massive 38% price jump, led to a 40% year-on-year increase in the total value.
40% increase in value terms. That's incredible. Okay, let's flip to the supply side. Could supply keep up?
Total supply edged up slightly, just 1% year-on-year, reaching 1,206 tons, matching the demand figure.
Where did that supply come from? Mining?
Mine production was actually very strong, hit a record for Q1 at 856 tons.
A record. So miners are pulling out more gold.
They are. But interestingly, recycling was down slightly.
Oh, why is that?
Seems like consumers were holding onto their existing gold, maybe expecting prices to go even higher. Less incentive to sell scrap when you think the price has further to run.
Makes sense. Hold on for better prices.
Hmm.
Okay, one last bit from that Q1 report. The over-the-counter market, OTC, and stock changes. What happened there?
Yeah, that's always a bit more opaque. But the report noted that OTC investment and stock changes were actually negative in Q1.
Negative. What might that indicate?
Well, a couple of possibilities. Maybe some of those big investors who usually use the OTC market decided to shift into those visible ETFs we talked about.
A switch from OTC to ETFs.
Could be. Or it might just reflect adjustments in inventories held by dealers and fabricators. It's harder to pin down precisely.
Okay, that gives us a really good snapshot of the recent market dynamics. Let's zoom out now. Why is gold so appealing as an investment in the first place? What's its enduring value proposition?
That's a fundamental question. A big part of it is gold's role as a store of value.
Right, holding its worth over time.
Especially when real interest rates, that's interest rates minus inflation, are low or even negative.
So when bonds or cash aren't giving you much return after inflation.
Exactly. Gold starts to look much more attractive as a way to just preserve your capital. It's like a safe harbor when other markets are stormy.
Makes sense. Is there more to it?
There is. Gold also has this inherent underlying demand from jewelry and industry. Even if investment demand cools off, there's always some baseline demand.
So it's not purely speculative.
Right. Some analysts call this an embedded put option, basically. There's a floor created by this physical demand. You can always sell it to someone who needs it for manufacturing or adornment.
A built-in safety net. Interesting.
Yeah.
I also came across some research suggesting a link between gold prices and U.S. real interest rates using a specific type of model.
Ah, yes, the no arbitrage models. They're fascinating. The research shows that if you calibrate these models using, say, 10-year real U.S. Treasury rates, they can actually replicate the major swings in gold prices pretty well, especially since around 2007.
Really? So the model tracks gold based on real rates.
Largely, yes. It strongly suggests that a huge chunk of gold's value comes from its role as an investment asset, reacting to how attractive or unattractive other safe assets like treasuries are.
That's a powerful point. It's not just a shiny metal. Its price is heavily tied to the investment climate. And there's a negative correlation, right? Gold up when real rates are down.
Generally, yes. And that negative link gets even stronger when rates are already low. When real rates are high, gold's reaction isn't as pronounced.
Why is that?
The model explains it well. When returns on safe bonds are really poor, investors are much more sensitive, much more likely to look at gold as a serious alternative. When bond yields are high, gold faces tougher competition.
Right. The opportunity cost of holding gold is lower when rates are low. What about volatility? Does that play a role in these models?
It does. The models suggest gold has an option-like payoff. Basically, when economic uncertainty rises, which means more volatility in things like discount factors, gold tends to benefit.
So more uncertainty equals higher gold prices, potentially.
The model suggests that. Investors are willing to pay more for that safe haven quality during turbulent times. Also, for non-US investors, the real exchange rate matters too.
How so?
Well, if your local currency weakens significantly against the dollar-priced gold becomes more expensive for you, which can dampen demand in your region.
Okay, exchange rates add another layer.
Yeah.
And how does this no arbitrage model stack up against other ways of looking at gold futures?
Quite well, actually. The futures prices implied by this model tend to follow patterns similar to what we see in the actual CME COMEX futures market.
Which isn't always the case with other models.
Right. Some more traditional macroeconomic models, the representative agent ones, often have trouble capturing the specific way gold futures behave. So this investment-focused approach seems to reflect reality better in some ways.
Interesting. Okay, let's shift focus again. Central banks, they're big players. How do their policies, like changing interest rates or buying bonds, impact gold?
Oh, central bank actions, especially from the U.S. Federal Reserve, can definitely ripple through the gold market. Things like changes to the federal funds rate or, QE and QT.
Quantitative easing and tightening. Let's start with interest rates. This is the usual link. We touched on real rates, but nominal rates.
Historically, it's a bit complex. Sometimes gold prices actually increase when the Fed raises rates.
That seems backwards, doesn't it? Higher rates usually make non-yielding gold less attractive.
It does seem counterintuitive, but one theory is that rate hikes often happen when inflation is a concern, so investors buy gold as an inflation hedge, outweighing the rate effect.
Hedging against inflation.
Okay.
And when rates go down.
Then gold might stagnate or even fall, as other interest-bearing assets become relatively more appealing compared to zero-yield gold. But it's not always clear-cut.
Got it. Now, what about QE and QT, the big bond buying and selling programs?
Quantitative easing, QE, where the central bank buys bonds, pushes money into the system, and tends to push down longer-term interest rates.
Which should be good for gold.
Generally, yes. Lower bond yields make gold look better by comparison. Quantitative tightening, or QT, is the opposite. The Fed lets bonds mature without replacing them, shrinking its balance sheet.
And that leads to...
That can put upward pressure on bond rates, which could, in theory, make gold less attractive.
So monetary policy levers can push gold around, but it sounds like it's not a simple one-to-one relationship.
Absolutely not. It's crucial to remember these policies don't happen in a vacuum. Inflation levels, geopolitical events, the overall economy's health, they all play a huge role, sometimes a bigger role than just the Fed's actions.
Central bank policy is just one ingredient in the mix. Speaking of which, what do experts generally advise about holding gold in a portfolio? Is there a rule of thumb?
Many advisors suggest a modest allocation, maybe somewhere in the range of, say, 5% to 10% of a diversified portfolio.
Why a range?
The idea is it can act as a hedge, a bit of insurance against unexpected market shocks or economic downturns, without dragging down overall returns too much if gold doesn't perform.
A diversification and hedging play. Makes sense. Now, forecasting. Predicting gold prices seems incredibly difficult given all these factors. How do people even try?
It is tough, but researchers are always exploring methods. Machine learning is getting applied here. Models like LSTM, that's long short-term memory.
Right. Complex AI models.
And also more traditional statistical methods like linear regression.
How do they compare? Has machine learning cracked it?
Well, one study looking at daily prices from 2000 to 2020 had a slightly surprising result. The simpler linear regression model was actually a tiny bit better at predicting the direction of the next day's price move up or down.
Really? Linear regression beat LSTM on direction?
By a small margin, yeah. About 53% accuracy versus roughly 51% for LSTM in that study.
That is surprising. But maybe LSTM was better in other ways.
Potentially. The same study found LSTM had slightly lower error metrics, like mean squared error. That suggests, while it wasn't quite as good at calling the direction, its price-value predictions might have been a bit more precise.
Interesting trade-off. One better on direction, the other maybe closer on the actual price level. Did the study mention limitations?
Oh, yes. A big one was that both models really struggled to predict accurately beyond a very short time frame, like maybe 3 days out.
Only 3 days.
Yeah. It highlights just how hard long-term forecasting is, and that these models likely need to include a much wider range of influencing factors to be useful further out.
Right. Short-term noise versus longer-term fundamentals. What other factors are researchers trying to build into forecasting models?
Things like major stock indices, the Dow, the S&P 500. Also, overall gold supply and demand figures, treasury bill rates.
Trying to capture more of the picture.
Exactly. And for some countries, even domestic gold production levels can influence whether their central bank decides to buy or sell gold.
Linking production to central bank activity. Okay, speaking of central banks, let's pivot to their role more directly. They hold a lot of gold. Why?
It's a huge topic. Central banks are definitely major players, and their activity in the gold market is significant.
We hear they've been buying a lot recently.
They have. As a group, central banks have been net buyers at a pace not seen since the late stages of the Bretton Woods system back in the late 60s, early 70s.
Wow, that's going back quite a way. A major shift.
Absolutely. This official sector demand can be a really powerful driver of the gold price. Sometimes it even outweighs all the other demand components combined: ETFs, jewelry, tech, everything.
So when central banks are buying heavily, it can really support the price.
Definitely. A big purchase announcement can send a strong signal.
But you mentioned earlier their dealings can be a bit opaque.
That's right. Their transactions aren't always reported immediately or with full transparency, so their impact is significant. But sometimes it's happening somewhat under the radar compared to, say, daily ETF flows.
Interesting. And this trend of them buying, is it new? A reaction to recent crises?
Actually, no. The current trend of net buying, mostly by emerging market central banks, started well before the pandemic. It points to a longer-term strategic shift.
So it's not just short-term panic buying. What are the core strategic reasons for them to hold gold reserves?
Gold serves multiple critical functions for them. One big one is diversification, reducing reliance on just one currency, usually the US dollar.
Moving away from dollar dependence.
Right. Another is risk reduction. Gold has no counterparty risk. It's not someone else's liability.
Unlike holding in other countries' bonds.
Exactly. It can also be used for international payments in a crisis, serve as emergency funding, and then there's legacy holdings and national prestige too.
So stability, independence, crisis insurance, history, and status. Quite a list. Does holding gold actually make a central bank seem stronger?
Some academic research suggests it does. Having substantial gold reserves can enhance a central bank's perceived creditworthiness, especially during turbulent times or domestic crises. It bolsters confidence.
So it projects financial strength. What about geopolitics? Does that encourage central banks to hold gold?
Very much so. In an uncertain world, gold is seen as a safe, independent store of value. Holding gold can offer insulation from the policies of major central banks and potentially even help mitigate the impact of things like international sanctions.
A tool for financial and political independence. Okay, fascinating. Let's get right down to brass tacks. Who actually sets the price of gold? It's not like a company announcing a price tag.
Right. It's more dynamic. You can think of the price in a few ways. The spot price, the LBMA benchmark price, and futures prices.
Okay, let's define those. Spot price.
That's the price for immediate delivery. It's like the right now price, constantly fluctuating based on real-time supply and demand, currency movements. It's the benchmark we usually see quoted.
The live ticker price. Got it. What about the LBMA price?
That's a benchmark set twice a day through an electronic auction run by the London Bullion Market Association. It's used for settling large contracts, providing a standardized reference point that smooths out the tiny moment-to-moment spot fluctuations.
More stable average for big deals. And futures contracts.
Those are agreements to buy or sell gold at a set price on a future date, traded on exchanges like COMEX, used for hedging risk or speculating on future price direction.
Locking in a future price. So back to that spot price we see fluctuating all the time. Where does that number actually come from electronically?
It's primarily derived from trading activity in the major gold futures markets, especially COMEX in the US and the LBMA market in London.
So the futures market drives the spot price.
Essentially, yes. The continuous buying and selling of futures contracts, especially those for near-term delivery on these big electronic platforms, is what determines the widely quoted spot price. It reflects the collective sentiment of major traders and investors.
Okay. But you mentioned earlier that an ordinary person usually can't buy gold at that spot price. Why not?
Because the spot price is just the baseline price of the raw commodity. It doesn't include all the costs of getting it from a mine into your hands, refining, manufacturing into a coin or bar, transport, insurance, dealer profit margins.
All the value-added steps.
Exactly. The difference between spot and what you pay is called the premium, covering all those extra costs.
Makes sense. Spot is wholesale, retail includes the markup. Okay, finally, let's talk geopolitics again. We know it matters, but how direct is the impact?
It can be very direct and very significant. Geopolitical risk, whether it's actual conflict, rising tensions, or just the perception of instability, often triggers moves in the gold price.
And we can measure this risk.
Yeah, there are indices like the Geopolitical Risk, GPR index, that try to quantify it.
Yep.
And you often see gold rally when these indices spike.
Why the rally?
It's classic safe haven demand. When the world looks risky, investors often shift money into assets they perceive as safer, less correlated with stocks or bonds, and likely to hold value. Gold is a prime candidate.
We've definitely seen that play out many times.
Blah.
Do those gains last?
Often, no. Historically, once the specific crisis eases or tensions subside, gold tends to give back some or even all of those safe haven gains. The immediate fear factor fades.
So the rally can be temporary.
It often is for specific events. However, there's an argument now that maybe the frequency of geopolitical shocks is increasing. If the world is becoming generally less stable,
Then maybe that provides a more constant underlying support for gold.
exactly. Some talk about the end of the post-Cold War peace dividend. If we're entering an era of more persistent uncertainty, that could create a structurally more supportive environment for gold due to ongoing background safe haven interest.
A very interesting thought. Okay, this has been a really comprehensive deep dive. We've covered so much ground.
Yeah, from Q1 demand details, ETF flows, China's buying.
To why gold works as an investment. The link to real rates, those no arbitrage models.
The impact of Fed policy, QE, QT, central bank strategies.
How forecasting models work or struggle. Who sets the price. The spot versus LBMA versus futures.
And finally, that big influence of geopolitics and safe haven flows.
It really shows how many different forces are constantly pulling and pushing on the gold price. It's incredibly complex.
It really is. Understanding all these different angles is pretty crucial if you're involved in the gold market in any way or even just curious about it.
Well said. And that wraps up our deep dive for today here on the Gold Talk Show.
Hope you found it useful.
If you did find this discussion valuable, please do hit that like button, share the video with anyone else who might be interested, and definitely subscribe to the Gold Talk Show channel. We bring you these in-depth analyses and the latest gold news regularly.
And one final thought to leave you with. Considering everything we've discussed today, investment demand, central bank moves, monetary policy shifts, geopolitical risks, what do you think will be the single biggest influence on gold prices over the next few months? Something to ponder. Thanks for tuning in.
Thanks, everyone. See you next time.